Today's investing and financial world is more and more complex, and there are a raft of individual categories and products relating to investments that we can pick from. So how do you know? We're going to start with some of the basics. There are, in various classes, we're going to be doing courses on equity, on fixed income, on mutual funds, on derivatives and alternative investments. But we're going to focus in this first session on stocks. Stock is an ownership interest in a business venture, and it's usually represented by a security which evidences that ownership. You can still get a stock certificate as evidence of that ownership if you know who to ask. There are several classes of stock, each with its own unique characteristics. Recent surveys by regulators indicate that more than 75% of Americans own stock in a company, either directly or through ownership of mutual funds, which in turn own stocks. When you buy the stock of a corporation, you have an ownership. It may be small, but you still own part of that corporation, and you're entitled to part of that corporation's earnings and assets. Stock investors are called shareholders or stockholders, and they make money when the stock increases in value and when the company that issues the stock pays dividends or a portion of its profits to shareholders. Some companies are privately held, which means the shares are available just to a limited number of people, a few people like the company founders, employees, and investors who funded the development. Other companies are publicly traded, which means their shares are available to any investor who wants to buy them. They're available for purchase on one or more of the exchanges like the New York Stock Exchange or NASDAQ or the 35 others. Stocks have a unique identifier, usually a 3 or 4 letter symbol, such as DIS for the Walt Disney Corporation. There are a couple of different types of stocks. Common stock is generally owned by common stockholders that exercise some control over the business. Common stockholders get to vote on important matters like board members and mergers and acquisitions. There may be preferred stock, which also represents an ownership interest, but the rights of the preferred stockholder are different from that of a common stockholder. Common stock is the predominant stock found on stock exchanges, and it is the stock that's quoted when talking about a company's investment performance. Preferred stock has a claim on the company's earnings before payments to common shareholders, which would be important in the event of a liquidation. If the stock pays dividends, preferred stockholders are entitled to theirs at a predetermined rate prior to any dividends being paid out on common stock. Preferred stockholders generally don't have voting rights. So why would a company sell part of its ownership? There may be a number of reasons: providing liquidity to its original investors, raising money for acquisitions, product development, expansion. The first time a company issues stock is known as the initial public offering, an IPO, and the company receives the proceeds from that sale. This process is called going public. After that, shares of the public stock are traded or bought and sold among investors on the exchanges, but the corporation gets no additional income if something's bought and sold on an exchange. The price of the stock moves up or down depending on how much investors are willing to pay for it, following the laws of supply and demand. Occasionally, a company issues additional shares of stock called a secondary offering to raise additional capital. There are categories of stocks, and the primary way to categorize stocks is by their market capitalization. So a stock with a current market value of $30 a share and has 100 million shares of existing stock outstanding would have a market capitalization of $3 billion. Large and small refer to the company's capitalization, that is, the total market value of its outstanding equity. For instance, large cap stocks are currently defined as those with market caps greater than $4.5 billion. Mid-cap stocks are those with market capitalizations between $1 billion and $4.5 billion, and small-cap stocks are those with market values between $50 million and $1 billion. Stocks with capitalization under $50 million are sometimes called microcap, and there are a bunch of other categories of stocks, depending on capitalization, that are somewhat artificial but arbitrary. The designations are not standardized. Different practitioners divide the dividing lines differently. So And generally, large cap stocks tend to be less volatile than small cap stocks because small cap stocks generally represent younger, less established companies that don't have the financial resources of the large companies, and they're more vulnerable to a downturn in the economy. As you might expect, mid-cap stocks offer a middle ground, and they typically cost less than large-cap stocks and are less vulnerable in economic downturn than small-cap stocks. But another method of categorizing equities is to take their large-cap, mid-cap, small-cap categories and then divide it between value and growth. So you get large-cap value, mid-cap value, small-cap value, large-cap growth, mid-cap growth, small-cap growth. These are sometimes called style categories. But within growth and value, there are lots of different sub-strategies and different style combinations, and it gets fairly complicated. As financial advisors begin to understand the impact of investment styles on return and risk, they develop sort of customized categories, universes of stocks that represent only those securities that have the certain characteristics associated with the style being considered. The point is to be very careful about a moniker or a name, a large cap value company or a mid cap growth mutual fund. You have to look behind the numbers to see what composes this designation.